For more on the latest market moves, I want to welcome in Quincy Krosby, LPL Financial's Chief Global Strategist. Quincy, it's good to see you. So I was just talking there with Julie, and listen, the big event this week, Quincy, is going to be the Fed and the Fed's Jackson Hole Symposium. And of course, Mr. Jay Powell speaking on Friday morning. I'm just curious, Quincy, what you expect to hear from Jay Powell. Are you looking for a dovish Jay, a more hawkish Jay? What do you expect, Quincy?
I'm not sure Jay knows exactly which tone he wants. And sometimes I think he does, but then when he's talking, some of the market tends to focus on his, the way he's speaking. And we know also that the algorithms are very much focused on every word. We have seen in the past how the algorithms will move, and then once what the market is waiting for, September 18th, and whether there'll be a rate cut and how warm he is towards that, the algorithms will either push the market higher, the bond markets, and so on. So we don't know, because also we remember a number of the Fed speakers have been more cautious of late, seeking more confirmation that inflation is coming down at a reasonable pace. That's something that has been popping up as they have been coming out and speaking. The question then is, we get the minutes out, we want to know how deep was that worry that perhaps the Fed was moving too close to a rate cut in September. Similarly, Chairman Powell has been invoking the maximum employment mandate many times now. And even at the press conference, he made the point of saying they were monitoring closely the labor market. Well, this Wednesday morning, 10 a.m. Eastern, there will be a report regarding whether or not the payroll reports from April 2023 through March of 2024 has been accurately coming out with data about the number of jobs that were created. And there's a tug of war in the market, by the way, with those who say, hey, watch out for that number. I mean, granted, it's the first read, if you will, on that from that report, the preliminary report. But the fact is, if it looks as if the numbers that have been associated with the monthly reports, payroll reports, have been incorrect in the number of jobs that have been created, Chairman Powell is going to have to up his concern about the labor market. And that is also going to be factored in as to whether or not there will be 50 basis points versus 25.
Quincy, which side of that tug of war are you on? Are you worried about the labor market? And do you think that the Fed is going to have to be more aggressive as a result?
We're fairly pragmatic. We think that there will be revisions, and the revisions will show that they have not reflected accurately the number of jobs that have been created, but not to the extent that the extremists think what could be well over 1 million jobs not accounted for that have not been actually created. If that happens, then the Fed has got to acknowledge that they are increasingly worried about the labor market, because that would suggest that the numbers that we have seen suggesting a resilient labor market has been off.
I'm just push on one point, Quincy. I'm just curious to get your take on this. Let's say in September, Quincy, you got you got the traditional cut, 25. How do you think the market would actually respond and react to that, Quincy? Because obviously there's some out there who are banging the table that we should have a supersized 50.
Well, they always say first cut should be the deepest, but the fact of the matter is what the market wants above all else is a rate cut that is commensurate with inflation coming down. The market doesn't want a bigger rate cut that comes from almost an emergency, that, oh my goodness, the labor market is much weaker than we thought, because that smacks of a deeper economic slowdown. You saw what happened with the market as those yields just dropped with a very stark economic scare, and the equity market sold off. And this is before the big global yen carry trade unwind. So this is the market saying, Give us the 25 basis points as long as it is about inflation coming down. But if the market felt that you got 50 basis points because the Fed was really worried about the labor market, that would have a negative consequence for the market.
So, Quincy, put it all together for us. What should investors do, given these 2 weeks that we're looking at here?
Well, you're still going to have bouts of volatility. August isn't going away and going out smoothly. It never does. So we will have more bouts of volatility, and September could be really nasty for the market as well. But overall, you want to be in high quality names. You want to be in names that are going to have cash flow regardless of the scenario. And you also want names that offer dividends. As the rates come down, whether they come down because there are concerns about economic growth or just a coming down because inflation is in fact coming down. You want to look at more dividends. And by the way, you look at the energy sector today, look at the XLE. Those names provide tremendous opportunity with dividends. And also in many of the industrial names, the broader industrial sector has many names with dividends. And I think the market is going to be looking for those names increasingly as yields continue to come down. Utilities have climbed higher, not just because the market is worried, but the market also knows that one way or another, those yields are coming down, and utilities provide a very attractive alternative.
Quincy, I can't let you get out of here without talking about politics. The DNC kicking off in Chicago, Quincy, President Biden tonight. I am curious, Quincy, how you're talking about the election with your clients. How are you thinking about it broadly as a strategist?
Well, we're thinking about it broadly in terms of historical patterns, and that is that the market will do what the market does regardless of who's in the White House, because what also matters is the composition of Congress. You could have a Republican or a Democrat in there, but increasingly over the years, if you don't have a majority to get you through with what you want, you can't continually just write what you want out of the Oval Office. So you're going to have trouble. But the fact of the matter is the market does well and poorly under Republicans and also under Democrats. And that's what we've been showing clients. What really matters, though, are the sectors associated with either party. And that's something that we focus on leading up to the election. One other thing I want to point out of the studies that we have been seeing, but we've also been doing ourselves, is that when the VIX climbs and going into election day, that could make or break whichever party is associated with the VIX climbing higher. The VIX has a very strong positive correlation with whether or not the incumbent party can actually win. So it's going to be interesting. And last but not least, both parties are seeming to agree with each other on some of the key issues. They're switching seemingly to the middle. We've heard Donald Trump talk about perhaps the need for more immigration, which set off a storm on the right wing of the party. And then we've seen Kamala Harris talking about, perhaps energy is okay. So the point I want to make is they're both seemingly moving towards the middle.
And then it's sometimes hard to predict ahead of time as well how those moves are going to go. Quincy, thanks so much. It's great to see you.
Yeah, thank you.